Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm very excited to welcome Matthew Piepenburg to the program. An author, former hedge fund manager, expert on the precious metals sector, and a partner at Von Greyers. Today, we're going to discuss why all wars are bankers' wars and explore the connection between escalating global conflict, out-of-control government debt, and massively inflated financial markets. Matthew sees a debt crisis ahead that could decimate the stock market. What are the signs he's watching for that will signal the beginning of the end? We're also going to talk about why he thinks the gold bull market hasn't even started yet. We're on chapter 1. We're going to talk about why silver is tremendously undervalued in his eyes, and so much more. Before we dive in, get your Commodity Culture merch today using the link in the description below. Hats, t-shirts, mugs, hoodies, all backed by a 100% quality guarantee. And now, my friends, strap yourselves in for my conversation with Matthew Piepenburg. Matthew Piepenburg, great to have you back on Commodity Culture. Always enjoy our conversations. And today I want to start the conversation off with escalating global conflicts. Obviously, we've seen Iran and Israel heat up for a while, now calm down to some extent, a potential ceasefire or an official one that has been announced, but it's always very tenuous there. But the thing I want to focus on the most is not the conflict itself, but its connection to debt and to the global financial markets. I had G. Edward Griffin, author of The Creature from Jekyll Island, on the show last week, and he was saying we've been fooled again. You know, the headlines that we see in the news about these wars are not the real reason that these wars are actually going on. And there's a huge connection to the banking class behind the scenes, the military industrial complex. So why don't you break down for us how you see these wars and their connection to global debt, global economy, and financial markets?
Yeah, look, I completely agree with the assessment in the intro, and they're all connected. It's not just what we see on the legacy media, and that's not to be a legacy media shrill or to just, make the common criticism. It means these are very desperate times, and desperate times often see desperate measures, desperate policies, and desperate dishonesty. We are at the end of a credit cycle. That's very boring. It sounds like a term of art, but the end of a credit cycle, and since fiat money is credit, it's also the end of a fiat money cycle. It's the end of a dollar cycle. And it's the direct consequence of a massive debt cycle. And debt, currencies, precious metals, and military complex and geopolitics are all connected. And of course, neither you nor myself in the investment space pretend to be an expert on geopolitics, but we have to address geopolitics. None of us really knows exactly what's going to unfold or what the financial motives of every party was and what the wisdom was. We have a lot of questions. I will say it reminds me again of a quote I've used so many times in written reports, from someone who's not a financial expert, Ernest Hemingway, a fiction writer, but also a veteran, direct veteran of the First World War and a participant in the Second, very familiar with the Spanish Civil War. But he said, look, when you have debt-soaked nations, that always leads that debt, like a credit card binge, it always creates a temporary prosperity, and that temporary prosperity can last decades. And we've certainly seen that in the S&P and the risk assets, and in the top 1 to 10% of the U.S. population and in Europe as well. But that temporary prosperity is always followed by what he called the permanent ruin of currency debasement and war. And currency debasement and war are very linked because wars are, maybe they're ideological, but they're typically financial. And I hate to be so second or third derivative or reductionist, but conflict comes from financial stress, whether it's the U.S. Civil War, whether it was the Second World War post Weimar. Pick a conflict. There's usually a financial motive or a desperate economic backdrop to it. Now, when Hemingway said that, that was in a pre-nuclear era. The stakes are higher, and so either the comfort or the fear is higher, depending on, some people think it's just too much madness. In a nuclear era, we can be protected. Others think there's too much to lose. This is crazy. But again, not wishing to be an expert on what's going to happen next or who's to blame, we have to look at these things without being pretending to have a moral compass here or to be right and everyone else is wrong. But we have to look at things objectively without a bias, or try without a bias, And again, with the topic of conflict and war, whether it's in the Ukraine, where you've had, look, objectively over 1.5 million Ukrainians killed, not to mention how many more were maimed, in what Jeffrey Sachs and many others have called a completely avoidable war, then that's a question. But regardless of our views on that war or what we think of Putin or Zelensky, we should all be appalled by that number in such a short period. And we should be appalled by the images of young men being pulled off the streets into vans and taken to the front line where the average life expectancy is less than a week. That should just be appalling. And again, I'll tie this into financial matters, but in Gaza, which has a population of 2 million, there's at least 50,000 dead. Whatever your views are in Israel or Palestine or Gaza or the West Bank, we should all be appalled by that. And, and that's in a population of 2 million with 50,000 dead in a population of 2 million. That again doesn't include those who've lost arms, legs, or maimed or injured in graphic ways. And that means you're looking at one or two of every 30 people know somebody who, everyone knows somebody who died or was maimed in that war if you're in Gaza or the West Bank. That's going to be hard to create hearts and minds for potential peace in that region, however that unfolds or doesn't unfold. So these numbers may sound dry, but they're very human, all too human, and we shouldn't lose track of that, whatever our bias or whatever our perspective, whether it's geopolitical or markets. And I think it is important to ask questions without being sanctimonious about the answers. There are some like John Bolton or Lindsey Graham or certainly Netanyahu or the famous quote by Isaac Herzog that there are no innocents in Gaza and everyone's Hamas, everyone's Hezbollah. I think that's really reductionist and dangerous way to start. And I think you have others like Gideon Levy or Miko Peled, who wrote this famous book called The General's Son, or certainly Norman Finkelstein, or even the South African International Court, which is questioning the morality of what's happening and what is, they say, an apartheid state. Now, you can have different views on that, again, but I think we should all be concerned about the human costs. um, I think we also need to be, when we're talking about Israel, we've talked about the Ukraine so many times, but the Likud party isn't all Israel. It doesn't represent all Jews in the world. And Netanyahu doesn't represent all Jews. And certainly, Miko Peled or Gideon Levy or Norman Finkelstein are not anti-Semitic. So if anytime there's a critique of AIPAC, Netanyahu, the Likud party, Zionism, it's too simple just to criticize the critique as being anti-Semitic. We see that in the legacy media too much. I think that's absolutely wrong. You had Sir Richard Dalton, who was a former ambassador out of the UK to Iran, objectively saying that's just not helpful. I know people in Tehran, I know people in Tel Aviv and Jerusalem. These are human beings. So we have to try to find the human reality behind this, and we have to be able to ask these questions. There are questions about, we all know in the Iraq War, we didn't get the true narrative on weapons of mass destruction. We just didn't in 2003. I have a question about Tulsi Gabbard in March telling the Senate and the Congress that from her intel, she's the head of all intel, and they share intel with MI6 and even Mossad. At least as of March, there was no nuclear threat out of Iran. So again, do I know? No. But Tulsi Gabbard has been quiet for a long time since the ceasefire, and prior to that, we have to ask, what is the truth? We've all seen Netanyahu, who doesn't, again, represent all of Israel, come to the U.S. many, many times over the last 20 years, saying that Iran was seconds away from nuclear weapons. I don't know. I don't know. I don't think any of us really know. But these are important questions. The War Powers Act, does Trump really have the right to sneak in a surprise attack? Is that for national security, or is that following someone else's foreign policy to the risk of our own detriment? These are questions I don't have the answers for either. AIPAC, we saw the Tucker Carlson, Ted Cruz interview. Is AIPAC just a benign influencer, or is it a powerful influencer on U.S. foreign policy? There are strong arguments on both sides. John Mersheimer wrote a book many, many years ago that just got him pilloried in the academic community. Now he's more credible. He was just as credible then, but that was a sacred cow you couldn't critique. And we have to ask why. Why can't we critique that? Again, I don't have all the answers, but I do think, to my original statement, desperate times create desperate measures. I think the war in Iraq, Syria, Afghanistan, Libya, and many others would agree, regardless of your political bias, were not wars of Operation Freedom or bringing democracy and comfort to those countries in the Middle East. Like, they were very much driven by oil. I've talked to Doomberg, the brilliant chicken head. We had a great talk on energy, and he said very clearly, energy is life. It's a base layer of money. This is getting into the economics of war. you know, Energy is life. if we're talking about if we burn energy to produce and pay for things, there's the power is not in the currency, the power is in the oil. There is power in energy. Iran has 30% of the world's oil, it has control over the northern bank of the Straits of Hormuz. Yes, if we could have a regime change in Iran, that would help the U.S. in a way to have a friendly component to that oil trade. It would certainly handicap India, or excuse me, India and China that have benefited from the dark oil that's come through these teapot refineries and these false flag, these fake banner Iranian ships bringing oil to China and India. But again, there are economic motives. I think any of us who sat through the last 15, 20 years of post 9/11 foreign policy in the Middle East and in Afghanistan, and frankly, even the rare earths in Ukraine, there is a financial motive behind our policies. Whether there's a morally good justification for that is up for each of us to determine on our own. And I, as a bond trader and a precious metals expert, I'm not here to give the final answer on that. But I think these are very, very important questions. And I think in terms of the markets too, and I'll end on this when we're talking about conflict, because I think it also is a matter of this kind of cognitive dissonance, this kind of almost indifference at the market level. I mean, what was amazing to me about the recent headlines, I'm not even getting into the Ukraine debate, is just, Ronnie Sturfler, advisor at Von Greyer's, said it was like the S&P, the NASDAQ, and the Dow was like a monk, like a Zen monk. And not only was it like a Zen monk, the S&P, the Dow, and NASDAQ actually went up. Oil went down 5%. When we're looking at ceasefire, tenuous war in the Middle East, Straits of Hormuz, Iran, Israel, and oil went up, gold went down, but risk assets like equities went up. It's fascinating. And you have to ask, how does it, I've joked many times over the years, and this is no offense to the Midwest. I'm from the Midwest. I said you could drop a nuclear bomb on Cleveland, and the markets wouldn't hiccup as long as they know the Fed is there to provide liquidity. We've just become so kind of, I want to say there's that moral hazard. After 9/11, New York real estate tanked by 15 to 20%. Within a few months, it was back up. And I think these crises at a market level, at a cold financial level, are just dip opportunities. Buy at the bottoms, buy at lows, or buy at temporary pullbacks. There's been kind of a realpolitik, an indifference to the human, all too human sadness, the numbers, which are becoming abstract, and just, hey, good news is bad news is good news. If there's a war, we're going to see more QE, we're going to see more Fed support, we're going to see lower interest rates, risk on. When it should be, we should be very concerned about the risk of nuclear weapons in the Middle East, or even, I would call that a Pearl Harbor strike. We were in negotiations with Iran when we did that surprise strike. That's exactly what the Japanese were doing with us when they did Pearl Harbor. So there's questions about this, but the markets, they seem to know, that they have this support from this they think immortal Fed and this immortal liquidity and this constant support, this constant airbag, which we'll get into, is a complete fiction and it's an illusion of temporary prosperity, to Hemingway's point. But even, as Martin Armstrong said, the Taco Tuesday, the Taco Trump, that whatever he says lasts about 30 minutes, then he pulls back, like Liberation Day, speaking very strongly, or talking about bombing Iran, speaking very strongly, but then pivoting very quickly or changing policies very quickly when things go wrong. And so there's a sense that, the world's become kind of hardened or softened, you could say, to the tough talk of Trump. And that's dangerous too, because Trump is very psychologically averse to being critiqued. So if they think he's soft, he'll get harder. Again, I don't want to be a psychoanalysis of Trump either. I've said many times he's a winner, not a leader. He hates to lose, and he'll do almost anything to win. What that means, we'll see. I think his ultimate motives are hopefully good, but again, this market reaction was staggering, and I think there is a sense that you know you know that we're really kind of experimenting as we go. The markets are really indifferent to the human suffering. Crises are actually opportunities because of this moral hazard that they think this liquidity, this is always going to be there in some form. And it could be true argumentatively that the liquidity is always there, that there's never a dip that can't be rebought. But again, I'll say this, and this gets into debt, the dollar, and currencies and precious metals. You can continually support a market, including a market on the brink of nuclear war, but you can only do that at the expense of the currency. And that, of course, is why we're seeing gold at all-time highs. The dollar down 10% this year. It's worst first half of a year in 40 years. And the world moving away from the dollar. All of this is connected. The dollar, the debt, the currencies, the credit cycles, again, and war. And long answer again to a short question, but we have a lot of questions that I don't have all the answers for. We should be asking them more. I think alternative media has, whether it's, Alex Craner or whether it's Jeffrey Sachs, obviously I have a bias towards these folks as opposed to Fox or CNN. thank God we have that and platforms like this to at least raise the questions. And again, it's sanctimonious for me to give the answer, my view on Israel, my view on Palestine, my view on Putin. That's not really helpful. I'm a precious metals guy. I'm a bond guy. But I think we're all human beings and we should be asking these questions. And before we answer them, we should look at both sides, whether it's John Bolton or Miko Peled or Gideon Levy. They're all relevant perspectives. You don't have to agree with them, but you should know them before you just start spouting emotions and making conclusions when there's this many lives at stake and more to come. And I don't know how it plays out, but these are desperate times in the currencies, in the markets, at the central banks, in politics, at the social level because of the inflation, invisible tax, and the centralization. These are very pressure cooker times for every one of us. And yet the markets rip on and they continue to live on the Pavlovian power of if the dovish Fed or a dovish central bank is behind us, nothing can stop us. And as long as there's that instant liquidity, party on.
And now a quick break to hear from our sponsor, ARC Silver Gold Osmium owner Ian Everard is considered one of the most honest and level-headed gold and silver dealers in the United States, praised even by his competitors. So give him a call today to take advantage of the specials right now. Silver Kangaroos 2023 1-ounce coins, mint fresh, only $2.47 over spot. Mint fresh silver maple leafs 2025 coins, 1 ounce, $2.87 over spot. While supplies last. Reach out today at 307-264-9441 or by email at ian@arcsgo.com and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Yeah, very great summary there. I do want to talk about the broad market in a little bit more detail for the moment because, as you said, almost a complete nothing burger reaction to the conflict. Oil initially shooting up and then falling back down. You know, there was obviously talk of the threat of the Strait of Hormuz closing, but I want to focus on the broad market because there's some things that are a little bit different this time around. I think the main one is the passive inflows through ETFs that are going into all these big names that are holding up the indices. I wonder how much of a role do you think that is playing in keeping this, you know, what some would call a bubble continuing? Do you think there's a big role as well being played by the algorithmic trading that, you know, super fast, high frequency day trading and the Fed, just as you said, people are looking to them to cover them and they've got our back. So just buy the dips. These are certain factors that I think are playing a role. I wonder what your thoughts there are. Obviously, by a lot of metrics, you know, the Buffett indicator calling the market extremely overvalued at this point in time. There's a number of other metrics we could speak about that are echoing that same sentiment. And yet here we are continuing to grind. NASDAQ hit all-time highs recently. What are your thoughts there on these various factors that might be a little bit different this time around than in the past, holding up the broad market?
Yeah, it's a very important question. I mean, a couple of things like Michael Burry a couple of years ago said he considered ETFs one of the most dangerous instruments in the markets. And again, most people know what an ETF is, but in the simplest terms, if you have a bag of marbles and maybe three of those marbles are very valuable and the other 50 marbles are kind of unvaluable, but those three powerful marbles in an ETF will keep the rest of that bag valuable. If you're investing in the ETF, even the other 50 unlovable marbles are going up in price because the volume of liquidity going into the ETF pushes all ships in that rising tide. And if you've got a couple big names in that tech ETF or all tech ETF, whether it's NVIDIA or the Fabulous Seven, they can draw in and bring in liquidity that lifts otherwise unlovable equities in. And so that creates an artificial inflation of all assets. Of course, the opposite would be true if NVIDIA or Google or Facebook takes a dive or Amazon takes a dive. Those healthy marbles bring everything back down. So they rise and fall together. And as Gunleck says and others, you know, markets climb upstairs and they take an elevator down. If something does go wrong, and there's a million things that it could, you know, that's an obvious threat. So the proliferation of ETFs, which sovereign wealth funds and 401k programs and even family offices, but your average investor, they run to those ETFs. Even traders trade ETFs and inverse ETFs. So they create this massive amount of demand from the few good marbles that lifts the price of all the other marbles. And that creates massive asset inflation. Of course, if you have a dovish Fed that's pivoted from rising rates, which failed to beat inflation and just caused, fiscal dominance and put Uncle Sam in a corner. If you now have a Fed that's lowering rates and probably going to either stay or lower further, and probably on the brink of QE at some point, we can get into why, that also is a very bullish tailwind. And of course, the Fed, like every central bank, has to choose between its bond market, its debt market, and its currency. And because debt is the rotten wind beneath the wings of every economy, really today, except for maybe ironically Russia, if debt and issuing credit and issuing sovereign bonds and IOUs is essential to stay alive, you have to keep the yields on those bonds down. You have to keep the interest rates down. So you have to create artificial liquidity to save that bond market, because if the yield on the 10-year treasury, and this is the stock my stock mind, my past, I know that if the yield on the 10-year goes above 5%, that means the cost of debt gets too high. That means equities go down. So right now, to answer your question, I think Michael Burry is right. These ETFs are temporary prosperity, which can lead to permanent ruin because they rise on rising tide of liquidity and low rates, and they tank if there's a needle that pops that system. And then all things go down. So between the ETF demand, a dovish Fed with a lower rate policy than it has 2 or 3 years ago, those two tailwinds are massive. And then again, the constant moral hazards, a whole generation of young traders coming in who've never really seen a bear market, who weren't there in 2000 or 2001 with the NASDAQ, or certainly weren't there at the GFC even. They've been conditioned to believe that we can have deficits without tears, and that a Fed will always be there to protect these markets. And that, as I said, every crisis is a dip, every dip is an opportunity. The high frequency trading, algo AI, mega computing trading is also kind of touted as this new savior, that we can avoid risk through these algorithms. And the high frequency traders are a massive percentage of the daily trading going on in the markets. That was true even when I was trading. And I know folks from Dallas to New York to Singapore who trade that way. They're not all brilliant. There is no easy answer, just like AI isn't an easy answer. But there's no doubt that that keeps a constant kind of electronic algorithm of demand going. And the signals that they would typically look at to sell it in a radical way are the same as the signals they would look at to buy in a radical way. And without getting, and I'm not a high frequency trader, but I certainly know that those programs are based on the cost of debt and interest rates and spreads between junk and between sovereigns. And those spreads are tight right now. Amazingly, high yield or junk bonds, they call them high yield. That's another euphemism out of Wall Street. High yield is just junk. But there's not much high yield in high yield bonds. And and again, when you look at the markets, you can say, well, Piepenburg's just a precious metals guy. He's a perma bear. I'm not. I've been risk on many times. I was risk on when we had unlimited QE in 2020. I was risk on in 2024 when Powell was announcing potential rate cuts. We knew they were coming. They didn't come till September, but just the announcement. So I'm not a perma bear, but I know realistically these are not sustainable markets. And again, as a precious metals guy, I'm less interested in speculation these days. But people I know or traded with or invested with, whether it was Ray Dalio or, I certainly rest with Jeremy Grantham. I loved his fund. He was a great manager. Uh, Paul Tudor Jones, even Pimco, uh, Druckenmuller, they are just, if not more bearish than I am, and they are following risk assets. But this brings us to the world of, McKay and Graham and Farrell. McKay was talking about the madness of crowds. This is the madness of crowds, these chasing these tops, this belief that the Fed will save you, this fear of missing out, this let's get more alpha out of a very Fed supported market. That is a madness. And it is euphoric during that temporary prosperity. But it is a very brutal karmic kick in the gut when things go wrong. And we can talk about those could be. And again, Bob Farrell, the guy who said the most important and overlooked power in the markets is mean reversion. That rubber band that goes up, comes down, it goes down, comes back up. Mean reversion would put the markets at 50 to 75% less than they are right now. That's a normal market cycle. Again, interrupted by the absolutely unnatural force of a central bank monetizing the bond market and therefore effectively, indirectly monetizing the equity markets. And then there's, Graham, the famous value investor. There's not a lot of good balance sheets on these markets. That's why Buffett's hundreds of billions in cash, despite the frothy tops now, which you just mentioned. Heinrich Zieberg, he's just as bearish as me, but he called for higher highs before this thing tanks, and he's been correct. So again, you can be temporarily bullish or you can be risk on in a very risky, topping market. That's up to your personality if you're a speculator. Sophisticated speculators would be, I think, more protected than just passive ETF investors who are listening to their, financial advisors or RIA industrial complex, which is pure consensus think. Because in a bull market, everyone looks brilliant. In a Fed supported market, everyone looks brilliant. And when something goes wrong, they'll blame that on exogenous events or black swans, and they'll take no responsibility. And I think there's a large class of people who can't afford another 40, 50% dip, especially if you're older. Um, and there's a society that relies on a 401k. There's a middle class that relies on a 401k that cannot afford that, because if we have another major dip, the only way to save that would be to have QE to the moon to effectively monetize the equity markets. You could even have direct investments in equities. Yellen talked about that years ago, or you could just do super QE, and that would create another headline bull, but that will be at the expense of the dollar you measure your portfolio in. And again, that dollar on a relative and on an absolute basis is compounding losses year to year. If we're losing 10% this year and 6% the year before and 5 and 9 before that, in just the last 4 or 5 years, you're losing 25%. So your dollar buys 25 cents less. On a compounding level, that is extremely painful. Buffett talked about that, don't underestimate compounding returns. Don't ever estimate compounding losses through the invisible tax of inflation and the debasement of your currency. That is absolutely fatal, and it ignores, even if the markets are up 7%, if the actual inflation is 9 or 10%, because we know the CPI is bogus. It's been adjusted 22 times since 1980. It's a fiction. We know without the BLS telling us that $10 or $100 doesn't buy what it did 10 years ago. It just doesn't. So if you're making 10 or $100 more, you're still running uphill in roller skates. I think that's the big trap. If you're getting 20% this year, or you got 8%, or Jeremy Siegel's annualized 8%, you're losing all of that to inflation anyway. And again, that's just empirical. It's not just trying to be negative, unless you trust the BLS's measure of inflation, which I never did and never will. So yeah, high frequency trading, ETFs, very, very dangerous combination with a very dovish Fed and a very, I think, comfortably numb retail investment class that thinks the next 5 to 10 years are going to be like the last 5 to 10 years. And the only way that the markets will stay at these levels for the next 5 to 10 years would be at the absolute expense of the dollar you measure your wealth in, or the euro or the franc or whatever. It's an absolute charade. It's a charade. And it's not sustainable, because eventually the bond market is not going to be saved by a central bank. The central banks think they can control bond yields. The central banks think they can control debt markets. And I've said many times, that's like a yachtsman, even a very talented sailor. That's like saying they can control the ocean. And my father-in-law, my mother-in-law sailed around the world twice on a boat he built with his own hands. And he saw many friends disappear in the Indian Ocean or across South Africa or coming up from Morocco. To think that you can control the oceans is hubris at its highest. But the hubris at its highest now is to think you can control the weather or you can control bond market. The Fed for many years has said they can do that, and the ECB, et cetera, but they can't. Eventually, bonds fall of their own accord, yields spike. You can try yield curve controls, you can try QE, you can try to liquefy that market. But eventually, the bond market will get the last laugh, and that will probably be the needle which pops this Fed air balloon and sends this credit cycle and those ETFs and those high frequency trading algorithms into an uh-oh moment. And that's where you'll see the escalator down as opposed to the steps up. And markets are mostly bullish. They're mostly positive. But when they're negative, really negative, um, they're brutal. And what's happening now is if we have another '08 moment or 2001 NASDAQ moment, we don't have the credibility anymore with our currency or our bond market to print 4 trillion or 5 trillion. And so there's going to have to be some pretty tough scenarios. The bond market is everything. It is the stock market. And we could talk about those scenarios are going to be, but there won't be another '08 dip with an '09 rip. There just won't be this time around. And so this temporary prosperity, this good times, and again, I can tell you what I think the signals are. I don't have the timing. That's a mug's game, but it's not sustainable. And enter at your own risk at chasing these tops. And again, I've chased tops in 2020. I've chased them in 2024, even though they were overvalued. But I'm much more like Buffett now. Enough is enough. I don't know if it ends in a week, a month, or 6 months, but I don't care. And frankly, I'd rather preserve the wealth that I have right now rather than chase some more. I recognize there are many who don't have that problem or that high class problem, and they're trying to beat inflation or pay the mortgage or get through the year by speculating. I respect that. I think they just need to be very, very aware of the risks. And even if they do succeed, quote unquote, an 8 or 10% annualized return, they've got to understand how inflation is actually just taking a lot of that away from them. And so what else can they do to prepare? And that's why I went from stocks and risk assets into precious metals, not because I thought it was a chance to get rich quick. I thought it was a chance to avoid getting slaughtered. And I'm very proud of that. I mean, gold is up 25 whatever percent this year. It's the best performing asset of 2025. It's outperformed the S&P for the last 20 years on a total return basis. So even on a purely speculation mindset, gold has done better for me than the S&P if I bought a passive ETF index. But again, I realize Nvidia or Bitcoin in certain periods can rip past anything else. But again, there's all different ways to look at your statistical windows or look at your asset classes. I'm not against speculation at all. But I think at this particular time, and I've said that before, there are times where the risk is obvious, but I'm risk off right now because I don't think this is sustainable. It wasn't sustainable in 2020 when I went long. It wasn't sustainable in 2024, but there was a window there. When the Fed is printing money unlimited, it's risk on. When the Fed is bringing rates down, it's risk on. Because again, and I'll end here, the markets are no longer driven by supply and demand and natural forces or constructive destruction where bad companies fall out of that ETF bag. The markets are driven by liquidity from a central bank or the hope of liquidity from a central bank if anything goes wrong. That is not capitalism. That is not natural price discovery. And that is frankly not the stock market of Benjamin Graham or Warren Buffett in the 70s. It's just not. So, we're in a very desperate time. It looks good right now because of a rising S&P, but that's lipstick on a pig, Jesse. That's what I see. It's just lipstick on a pig. It's hiding trillions of cracks, trillions of cracks.
Well, let's talk about those trillions of cracks and what it is that you think could potentially deflate this bubble. Obviously, this could also be a very violent and fast deflation, as you mentioned, taking the elevator down. And how much do you think currency debasement does play a role in the rising value of the broad market? Obviously, an extreme example like Zimbabwe, when they went through hyperinflation, their stock market went ballistic. So if you just looked at the chart, it would look like, wow, this is amazing. Do you think there's a little bit of that right now in the broad market? And what are the main catalysts and cracks that you see that could bring this whole thing down? And what would be the implications of that?
Yeah, and I was talking to John Rubino, 3 weeks ago maybe, and this was before the Iran war even was really heating up, or the Iran, whatever you want to call it, interaction. Um, and he was just saying, gosh, if we have war in Iran, markets go down 30%, of course. And yet you could say we didn't really have a war in Iran, so that really didn't count. But again, what would really cause these markets if not even the threat of a direct involvement with a country the size of Europe in the Middle East next to, the Strait of Hormuz on the border of Iraq and in Kuwait? If that didn't scare the markets, what will? So what could possibly do this? And again, if you start with the premise, and this is my premise, if I'm wrong, I'm wrong, but I'm pretty confident that this is what markets have taught me. I've always known on Wall Street that the varsity athletes, the smartest guys in the room, were not the equity guys. They were the bond guys. I'm not saying I was one of the smartest, but the best equity traders had a background in credit, not just because they could, you know, underwrite good risk or find good balance sheets or understand, financial statements, but because they looked at rates and they looked at the cost of debt, because everything is about debt, whether it's rolling over or stock buybacks, which was going on for years. That was the biggest easy scam that was totally legal to push stock prices up and bring earnings per share up just based on buying shares. But whatever you look at in the markets, if you're looking at stocks or the S&P and the Dow, you still have to look at the 10-year yield. You still have to look at the bond market and the spreads. And you don't have to get wonky. It's very simple. If the cost of that is too high, markets come down. If we have a credit crisis, and that's what I think it will be. Now, if there's an assassination tomorrow, if there's a dirty bomb, if there is an invasion of Florida from somewhere, I mean, I can't predict these things. There are some things none of us can predict. That would certainly, hopefully, not hopefully, but if in a real uh-oh moment, markets will go down if there's something cataclysmic. Failing that, which we can't predict, failing those type of black swans and the unknown unknowns, the gray swans, things that are visible and very dangerous, is very simply our debt market. It's very simple. The debt is unsustainable. And this gets into currencies and gold. But look, global GDP went from 30 trillion in the 90s to 300 trillion today, just globally. And in 1971, when we got off the gold standard, again, these are boring numbers, but US debt, public debt, government debt was 246 billion in 1971. Now we're looking at 37 trillion. That's extraordinary in a 50-year period. And our debt to GDP in the 70s was 38%. Now it's at World War II levels of 125%. And again, I'll pause for a second. Just trying to think of those as just me showing up with numbers I can memorize. Think about what that means when you go from 240 billion to 37 trillion. And Rubino had told me something else was very true. You know, a billion seconds ago was 1997. A trillion seconds ago was 30,000 BC. Just to try and conceptualize the difference between a trillion and a billion. So when you go from 240 some billion in public debt to 37 trillion in a 50-year period, it becomes inconceivable. Not only is it inconceivable, it is mathematically unsustainable. So what I'm to answer your question, the debt market and the rise of the cracks in this broken system is going to be, in my opinion, what breaks the stock market. And we are clearly seeing that now. You know, Egon, my colleague, said in 2016 that U.S. public debt would be 40 trillion by 2025, and he looked like a total kook. They thought he was crazy, but that's exactly where we are because our debt doubles every 8 years. So the bond market is the thing. In a credit collapse and sovereign bonds like the US 10-year, the risk-free return, which again is return-free risk when you measure against actual inflation, when the debt keeps getting bigger and bigger, our deficits go from every 6 months up $1 trillion. Our public debt gets higher and higher. Our entitlements, our military spending, our interest expenses. It comes to a point where that pressure cooker pops. We've seen signs of that in the de-dollarization and the rise of the BRICS and the COMEX outflows, in the BIS giving gold a tier one status alongside the 10-year. We've seen that in the petrodollar moves outside of the US dollar, blah, 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 blah. But that's all happening because no one trusts the world reserve currency today like they did 10 years ago. And no one trusts the 10-year IOU from Uncle Sam like they did 10 years ago. Why? Because we're in too much debt, because no one thinks it's sustainable, and because we weaponized that world reserve currency in 2022. Again, whatever you think of that, it's no longer trusted. What central banks have been doing since we weaponized the dollars is mathematical. They've tripled their gold buying. Every year since then, central banks have bought over 1,000 tons a year. Individual central banks went up from 118 tons to an average of 290 tons. They basically tripled. Why? They don't trust the world reserve currency as a weaponized currency. They don't trust the 10-year IOU because it's weaponized, and they don't like it because they know the government cannot sustain the debt. So there's a move away from that IOU. If there is a move away from our debt and we are a debt-based society, who's going to pay that debt? If they're not going to buy our IOUs, net, central banks have been net dumping IOUs since 2014. China's been de-dollarizing since 2013. So these are not just numbers, these are signs of trends. And the trends are getting more and more accelerated. As Hemingway said, poverty starts slowly, then all at once. We are hitting that all at once phase objectively. There is simply too much debt. There is a move away from US treasuries into physical gold to net settle trades in the BRICS, to buy oil, to settle energy trades, and even as a world reserve asset. So we're not even talking about gold anymore as a hedge or an allocation or even insurance for dying fiat money. What we are seeing in the last couple of years is gold is replacing the US dollar. And Nassim Taleb just said this out loud the other day in an interview with Bloomberg. It's constructively replacing the US dollar as a strategic reserve, or the 10-year US Treasury, excuse me, well, and the dollar as a strategic reserve asset, as real money. The kooky conversations that gold bugs have been having for years about credit or currency versus money or credit versus real money that was all laughed at is actually happening in real time. From the IMF to the BIS, to the central banks of the world. And the outflows we saw from the COMEX into the COMEX from London in the UK, 2,000 tons to try and cover their ratios of levered paper. Why? Because the COMEX needed more physical gold to meet delivery of countries and counterparties who now want that gold. They don't want to lever it. They don't want to speculate on futures. They want the real thing. Why? Again, because there is a slow but steady and obvious empirical shift away from fiat money in general, and the US dollar in particular, sovereign bonds in general, but most importantly, that sacred 10-year US Treasury. You can't underestimate. That is the only other tier one asset of the BIS. And they've just put gold alongside it. That was unthinkable 5 or 10 years ago. And even the IMF, when they talk about central bank digital currency and all the awful that's coming, and it is coming, and the DLT and the Bitcoin, not Bitcoin, but the blockchain technology is going to bring in central bank digital currency. All the problems aside, even that they said in their own graph in 2020 is going to be anchored in physical gold. Physical gold is the new direction. It's not even just an argument about currency risk or outperforming the S&P or whether it's a pet rock or an analog has been versus a Bitcoin superstar. All of that aside, just look at what the world is doing, not what they're saying. Look what they're doing. And they are absolutely moving towards gold. So, um, that again is a long-winded way to get back to the reason the risk in the stock market is because the credit market is tanking. And what's going to happen when the credit market and the debt levels, especially at the home of the world reserve currency, are this grotesque? Because when you add the 37 trillion and then you add our unfunded liabilities, which are 150 trillion, it's clear that we're never going to have that without debasing the money. So no one's going to trust the money or the IOUs. There's only three options. We can default, which is political, pretty much political suicide. Um, you know, we could default or we could have a productivity miracle. But as David Hume said, when debt to GDP crosses 100%, growth slows by 1/3. That's proven true throughout history since the 1700s. So we can't produce our way out. We can't default. So our next option is to inflate away our debt, to run negative real yields, to have inflation misreported as low, but actually be higher than the yield on the 10-year so we can debase the currency to inflate away our debt. That's the third option. The fourth option, which I think is going to happen after things really go to hell, is we're going to have some type of global reset, some type of uh, Bretton Woods 2.0, which the IMF telegraphed during COVID, some type of mix of the Plaza Accords and Bretton Woods. How clean that will be, that will happen after we go through the stages of grief. We denied the debt problem. We're going to have to accept the debt problem. Then we're going to get angry about it, and then we're going to do something about it. But I think that will be a reset, and that will be very messy because the BRICS and the G7, the G20 won't cooperate entirely, and that will cause a lot of stress. But those are the only options, really. It's default, produce your way out. Production is not going to happen. Inflate your way out, which is what we're doing now very quietly, which is why the dollar is losing strength, and then have some type of reset. And I've said from 2020, the IMF telegraphed that to us as like a psyop. That's how they always do it. They drop the seed, 5 or 6 later, they do it. And they're doing it. Everything's being tokenized, everything's being digitalized, and everything's being set up for some type of reset. In 2020, they tried to blame all of this on COVID, the debt crisis on COVID, which was insulting to the intelligence of anyone who's been following credit markets. It's just another sign of the pathological inability of the very fools that put us into this situation to take any accountability. Zero. They want to blame it on a war or a virus or some other thing instead of just their own reflection. And gold is a reflection of their failures. Gold is a reflection of their failures. And so that is what's going to happen, I think, and to try and quote unquote solve the problem. But as those debt levels get so high and the bond prices and demand go down, yields go up, cost of debt goes up, that's what kills the party. That's what creates the permanent ruin. And we're just flirting with that right now. We're flirting with that right now. Watching that yield in the 10-year is absolutely essential. Now, technically, again, the Fed or any central bank can print trillions. I mean, Powell printed almost 5 trillion in less than 2 years. You can print trillions, buy those bonds to keep the rates down, but you'll do that at the expense of the very dollar you're measuring your wealth with. So you see they're just in a vicious circle now. And the world's catching on. Your viewers are catching on. uh, Investors are catching on, and certainly our central banks in the BRICS countries and other bodies and sovereign wealth funds, et cetera, and hedge funds, they're catching on, and so that will be what sends this market down. That's when the elevator down comes fast. And again, you can look at net income margins. I saw this during the dot-com bubble. I saw this during the '08 crisis when I was trading risk assets. This was a hidden secret. But look at the net income margins of your favorite stocks for a long time. They can ride high on liquidity, on momentum. They can be good companies. I thought Lucent was a good company. Microsoft was a good company. There's a lot of good names in 2000 during the dot-com bubble. Amazon was a good company. Um, I mean, there's a whole list of those tech stocks, and their net income margins were ripping. But at some point, they started to flatten, and then they started to go down. When the big names go down, that's when you know you need to get out. Not necessarily short those names because you can get squeezed, but that's the sign. I'm looking at net income margins. I'm looking at the yield on the 10-year. If you wanted two things to look at, not to predict, but to track, because there's a difference. I can't predict the month or the day, but I can track the trend. And it is the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the 10-year, which you can save by printing money and kill the dollar, or the yield on the or you look at net income margins, the big leaders in that ETF bag, those bigger marbles, the fancy marbles. Again, I have nothing against Nvidia. I just think it's grossly overvalued. I have nothing against Lucent or Qualcomm or Microsoft in the 2000 era. But I knew when their net income margins were unsustainable and when they started to get down, that's when I got out of the markets. That was what many smart people did. And we missed months of good upside, but that was the sign. So it is that 10-year yield, the cost of debt, and it is those net income margins that are the signals. As of this date, I can't predict when those are going to turn and what's going to send this bond market into spiking yields and slower demand. And again, the problem is with the bond market, it can always be bailed out technically by the Fed. Always. You couldn't have deficits without tears. But please, please understand if you do that, it's at the expense of the currency, it's at the expense of the inherent purchasing power of your money, your currency, excuse me. And that is precisely why gold is seen over 75 all-time highs this year. That's precisely why gold is going exponential. And that's precisely why gold, even if it goes down or backwards for a myriad of time, its secular direction is going to be north because the secular direction of paper money, I'm sorry, is going south. And you can have Brent Johnson's milkshake theory, which I respect. He looks very strongly at Eurodollar demand, derivative demand, swap demand. But what he's missing is gold demand, and what he's missing is U.S. Treasury demand. They're going down. The dollar is still an absolutely essential fiat currency. But what I think the milkshake theory misses is what's happening with gold, which Brent Johnson certainly respects gold. He thinks it's the asset to be in. What I disagree with him on is I think he's missing that lack of demand now for a weaponized, over indebted, overissued, unloved U.S. Treasury. That to me is the thing. I've said for decades, or certainly the last 10 years, the bond market is the thing. If you understand yields and bond prices, you'll be far more prepared and less cynical. And you can even be a little bit safer. If the yields are down and the Fed is dovish, you can still be a little bit risk on. I wouldn't be, but you can be. And if net income margins are still sustainable, when they start to track negative and stay negative, that's when you need to get out.
Let's end on discussing the gold and silver markets a little bit more in depth. You mentioned you think the direction of gold is headed up, even if we do see a pullback over the long term. The strength is there due to all the tailwinds you've been speaking about. I guess my question on gold is for those looking to stack physical at the moment, this is actually a bit of a personal question for me because I'd love to buy some more gold, but I'm looking at prices today and thinking maybe I should wait for a pullback. Do you think that's intelligent at this point in time, first of all, especially for someone who has a long time horizon and isn't trading? What are your thoughts on the catalyst and the trajectory of the gold market at present? And also your thoughts on silver, because we've now seen silver trade above $35 and hold there for almost a month now. Obviously, inflation adjusted to even get back to previous all-time highs, you need triple digits. But nonetheless, very interesting price action, especially in a market that a lot of people believe is heavily manipulated. So, first of all, your thoughts on gold and the question of is gold overbought at this point, and then your thoughts on the silver market as well.
Look, it is the question for anyone who's new to gold or even been in gold for a while. Should I buy at these levels? I even have clients who've had for years. Should I buy at these levels? I see dollar cost averaging in, and I just wrote an article that I published today. Is it too late for gold? Have you missed your window? It's an absolutely fair question. And of course, you're going to say, well, Matt's an executive at Zurich. He's going to say, of course, it's not too late. Buy as much gold as you want. And that is my answer. But let me give some reasons why, so I'm not just pitching my book or selling my widget, because it's a fair and you should be skeptical. But you should also look at the facts and then make your own opinions. First, as you said, gold's at nominal all-time highs this year, but in inflation adjusted, it isn't. We'd still have to go up many percentage points to reach the 1980 levels. And measured against the broad money supply, gold's about as cheap now as it was in the 70s. That's just a fact. So you could argue on a technical basis that gold is still a good price in the 3,000, the 3,300, 3,400, 3,500. That seems hard to believe. I remember having this conversation with gold at 2,600. I've missed my window. I've missed my window. I remember with 19, because it wasn't that long ago, gold was at 1,600. And I'm not saying that gold just goes straight up. It could have some severe pullbacks, and you could wait for those. Uh, and so the other answer to that question is, and you just answered for yourself, is what's your time horizon? Because if your time horizon is 10, 20 years, as opposed to the next fiscal quarter or year end, and that's why a lot of family offices are afraid, because the CIOs or bankers or ex-bankers, their performance is measured, their salary is measured by their overall return. If gold pulls them down, they're thinking one quarter, one fiscal year. If you're actually being a fiduciary, you don't want all your boxes and allocations to be green. That means you're doing something wrong. But if you're thinking 10, 15, 20 years out, Whether you bought gold at 3,300, 2,900, or even 1,800 is going to be immaterial. My target, like Ronnie Sturflis for the next couple of years, is 4,800. But I think it's going, and again, I'm not saying this to just throw it out there. We're going to revalue gold. It's going to be part of the new reset whenever and however that involves. It's certainly replacing the 10-year. We're looking at gold at 10,000 conservatively, not next week, not even next year. Could be, but I have no idea how to predict that. But if I'm looking 10, 20 years out, it's going to be much, much higher than it is today. And whether you bought it 33 and change or 36 and change will be irrelevant in the long run if you're thinking that way. If you're trying to trade commodities or trade futures or trade precious metals, like any hard asset, you better have your stop losses in place. You better be looking at your Bollinger Bands, your Keltner Bands, and all that. If you're purely a speculator, that's a very different question. And I'm not the right person to ask. I've seen many commodity traders fail miserably at trying to time short or long hard assets. Again, but again, if gold does go to 4,800, then to 6,200, then to 10,000, again, that doesn't mean that you're doing the world is doing well. That doesn't mean that you're being richer, but that just means that the cost of a car tire or a house or a new mattress is going to be significantly higher. You can also certainly get price appreciation, but as Egon says so many times, it'll be a sad day when gold's at 10,000, but thank God I'm in it. And again, I use Egon as an example. He had made a lot of money as the chairman of a FTSE 100 company. He could have done anything he wanted with. He could have invested in any asset class. He bought gold at 300, not because he was trying to get rich when gold went to 3,500. This was 20 years ago or 25 years ago. He was just thinking, whatever money I made, whatever money I'm going to earn, it's going to be in a paper asset. It's going to be in a fiat currency, whether it's a Swiss franc or a euro at the time, or at that time, even before, a Deutschmark or whatever. But he wasn't thinking, how can I get rich on the money I have and get richer? He was thinking, how do I preserve my wealth? And that sounds very boring. So he just bought gold at 300, a lot of gold at 300. Now, of course, when gold goes from 300 to 3,500, he's extremely happy with the price appreciation. He actually got richer. But more importantly, he didn't get poorer. And that's kind of the model we look at. Yes, he got much richer by investing in gold, but that was never his motive. But you will get richer with gold over the next 20 years, even at these price points, is my short answer. I guess I say think like Egon. And he's been an immense mentor to me because I'm thinking 20 years out and I'm thinking of my grandkids and my retirement, so to speak, or whatever. I don't really need to be worried about polo ponies when I'm 75 or a new car. I don't really have the desire to get richer, but I could get richer on gold. But more importantly, I know I won't get poorer. And I'm saying that, again, Egon was all about wealth preservation, but yes, he also benefited from massive price appreciation and massive returns. And I think you can get both. And it's a long way of saying if your window is reasonable, respectable, and if you have conviction, because not once did Egon sell his gold when it was ripping into the 80s and then going down and these highs and lows, just stuck to gold because he had the conviction that eventually paper money would do what it always does and go back to its intrinsic value, which is effectively zero. Now, I'll repeat, when measured against a milligram of gold, the US dollar has lost 99.1% of its purchasing power since 1971. We went off the gold standard. That's a simplistic but very important percentage. You can look at it in different ways. But what Egon understood and what our clients understood, and a lot of your viewers understand, it's not that gold is rising over the next 10 years or the last 5 years, because gold has gotten more important in terms of its use or in terms of its shine. It's rising because debt markets and hence currency markets have gotten so pathetically embarrassing and so unsustainable and so discredited that gold is doing what it's been doing for thousands of years, getting the last laugh on failed policies from modern monetary theory and the fantasy you can solve a debt crisis with more debt and monetize that debt with mouse click money. These a 10-year-old should understand are fantasies, temporary prosperity leading to where we started, currency debasement and war. And we're in that currency debasement moment right now. It's not even predicting. It's happening right now. Regardless of the DXY, which is getting beaten, but regardless of the relative strength, the inherent strength, the absolute strength of your paper money, it's just losing value every day. And so, again, if you're 10, 20 years out, I wouldn't worry, Jesse, whether you buy at 33, 36, or 31. And I'm not telling you where the price is going to be next week because I don't know. No one does. I just know secularly it's going to go north because paper money has consistently gone south, regardless of the relative strengths of currencies. I'd much rather have a dollar or a Swiss franc than a peso. I would. But again, all of us need to protect against the obvious now decline in fiat money. And that's been our message for decades. It's still our message now, but I think Egon's example is telling. It's not a lucky break. It was a thought out conviction that will be just as true for people who buy today for the next 20 years as it was for him 20 years ago. I really believe that.
And your thoughts on the silver market at present?
Oh, yeah. Silver is important too. Of course, we should never forget silver. I don't talk enough about silver. Look, this is actually an indication of the gold price too. And this is my thought on silver. I mean, the gold silver ratio is hovering 100 to 1, crazy. And you think we're having this gold bull market, and yet silver, it's made moves positive, but not the dramatic moves where it really outperforms gold, which is confirmation of a gold bull market. And we've seen that throughout history, and we're not seeing it now. So that would make people think, has silver gotten less appealing? My answer to that is we're not in the gold bull market yet, even though we've seen these all-time highs. Silver's lagging because gold hasn't really begun its bull market rip. I really believe that. I'm not here to predict, there are people on TV or on certain shows calling six, seven, $800 silver. I don't know, or even $5,000 silver, $4,000 silver. That's a mug's game again. I know at 35, 36, or 37, it's going to be much, much higher than that in the years to come. So it's just a great high class problem to wonder, will it be 50 next year? Will it be 60, 70? But I think the gold silver ratio, we're not seeing the kind of the ratios we saw in 1980 or what was it, 2011 at 15 and 32. We'll see it again. And I don't know when. What I think the silver quote unquote lag, although it's certainly higher than it was 5 years ago, but I'm saying the lag in silver right now is because we haven't really seen the bull market yet in gold. I don't think we have. And yet it's done extremely well this year. It's the highest performing asset. But I think this is just chapter one of the gold story. I really do. And Egon, you could argue at $300 was chapter one. And but I think for the next 20 years, we're going to look back at $3,000 gold and say, what a bargain, sadly. And yet, even if there is a reset or a Bretton Woods 2.0 or a Plaza Accord 2.0, and we somehow magically get cooperation in a beautiful mind John Nash way with the BRICS and the G20 and everywhere else, even if we get that, whatever new system to come, and even the IMF has said this, despite its central bank digital currency programmability and trackability nightmare, for anything to have credibility in this new reset, they've said it. The BIS has said it. The IMF has said it. The World Bank has said it. For it to have credibility as opposed to just another new electronic fiat, it has to be covered in some significant ratio with a hard asset like gold. And so gold will be, again, playing a part of the new system to come. However smooth, ugly, discredited, or crazy, or whatever pain we have to go to get to that point, that reset is coming and that new money is coming. And that new money doesn't mean a gold backed dollar or a gold backed euro, but it's going to be a gold covered central bank digital currency. Will it be next year, next week? I don't know, but they're already moving in that direction so rapidly. If you follow the puck, again, it goes from gold no longer just being an allocation or a debate about low inflation, high inflation, low rates, high rates, strong dollar, weak dollar. It's broken from all those correlations. Now gold is simply becoming a strategic reserve asset for the new system. And that's, I think, not spoken of enough. And that is not pie in the sky. That is not sensational. That's actually happening. So yeah, silver is, I think, lagging only because gold hasn't even begun to rip yet. And I think silver right now at these prices, if you're patient, as Rick Rule said, silver rewards infrequently but extravagantly. Some people say it hasn't done enough for them. If you bought silver at 22, you should be content at 36, but you'll be very happy when it goes into triple digits. And silver is that little speedboat that rips past the juggernaut of gold. It's also more volatile too. So you got to pick your window. What's your exit? What's your entry? I'm going to buy silver so that when it rips, I'll sell it at a certain point. I'll never catch the high top. No one does. And then I'll use that to buy more gold. Hopefully, when gold is lagging silver in the growth space. But that's what most clients do. Silver is to speculate when the situation's right. If you're patient, it will reward you extravagantly. Sell, buy more gold.
Matthew, this has been a fantastic conversation. Really appreciate you coming back on the show. Tell us about Von Greyer's, where people can find that, and anywhere else you'd like to direct people online, feel free.
Yeah, we have our website at vongreyers.gold. It's also goldswitzerland.com, our old URL before we changed the name to Von Greyers from Matterhorn Asset Management. Our website has all the articles and interviews we do. It has a lot of free education on not just why gold, but how to own gold. We have a Von Greyers Substack now. Again, you could see interviews like this and any articles that Egon or myself write, Ronnie Sturfula, et cetera, and our advisors. It's all there, and you don't have to become a client. We are all about wealth preservation. We have the safest vault in the world. We have direct relations with refiners. We can give instant liquidity in any currency, but we hold gold and silver in some of the best, certainly the best vault in the world in Switzerland and also in Singapore. So we're there to help you with all the onboarding, bringing in, whether you have existing gold, you need to buy gold. If you need us to transport it anywhere in the world, we can do it. And if you need liquidity in fiat money, we save in gold and spend in fiat. We all do. And so there are times where there's a wedding, a house purchase, or something, you need some liquidity. We'll provide that liquidity very easily with our relationship with the refiners. So it's a very good high net worth service for high minimums, sadly, but the education we offer appeals to whether you're buying your first ounce tomorrow or whether you're buying 50 million worth of gold with us. It's the same thesis. It's the same knowledge. Egon and I are happy to talk to anyone who's interested in gold, whether they become a client or not. That's why we do these interviews. I personally am more interested in getting the middle class to protect themselves than just the high net worths that we represent, although that's fantastically rewarding. Anyone and everyone should understand why you should at least consider precious metals, especially in this current economic backdrop.
Completely agree. I'll put a link to Von Greyer's in the description below so people can check it out. Thank you once again, Matthew, for coming on and sharing your knowledge with the audience.
Thanks for having me as usual.
Thank you for joining us today. Take advantage of ARC Silver Gold Osmium specials right now. Silver Kangaroos 2023 1-ounce coins, $2.47 over spot. Silver Maple Leafs 2025 coins, 1 ounce, $2.87 over spot. Well supplies last. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.